The other thing I really wanted to get into is MOI. We talk about it all the time. Months of inventory, headlines all over the place talking about how months of inventory is jumping big time, and that should scare the hell out of all of us. What do you think about that?
Well, you can talk out of both sides of your mouth here. I guess I'm just going to share both sides of the story here. I feel like there is a lot of negative headlines out there that freak people out. And when you look at the actual data behind it, you become less freaked out. And so I feel like the media is largely doing what they are doing in order to get clicks and in order to get views. And so I'm going to try to share some of the actual data with you and also be a little forward looking, because guess what? The real estate market is changing. We needed it to change. I looked at this year. Do you know that we've had 25% home price appreciation this year? Like last year, it was 20%.
I did not. Are you serious?
Yeah.
Even with the interest rates and everything?
Yeah. Yeah.
Well,
we've had 25% home price appreciation here in Jacksonville this year. Last year, it was 20%. It was close to that the year before. Like,
that's exciting.
Yeah. We have all on the show talked about how, like, it's probably a good thing that homes don't appreciate at 20% or 25%. For me, as an owner of JWB, and the largest portion of our income comes from home sales, I would love it if home price appreciation would just stay steady at like 4.5% a year, year over year over year. Like, I would love it if we didn't go 25%, right? Because then that freaks people out about there potentially being a crash on the other side. If you look at how real estate pricing actually works over the long haul, there is a very, very small number of years that home prices have actually declined. It is not normal, but it raises that perception of people that they think it should happen. Here's the real data. The best short-term indicator of pricing is called months of inventory, MOI. If you're a fan of the show, we talk about it often. It just simply is how many homes are on the market versus how many sold the month prior. And what it tells you is the number of months it would take to exhaust the current inventory on the market. If you look over history, if you have between 6 to 7 months of inventory, that would equate to the average appreciation for your area per year. And in Jacksonville, that number is 4.6% per year. So all of that means once we get to 6 to 7 months of inventory, that would indicate that we would only have 4.6% appreciation per year, okay? Now, we've been tracking MOI every single month since 2014. Every single month we track this. I had never seen it below 3 months of inventory ever. It started to go below 3 months of inventory like 2 years ago, which is why on the show we talked about how home prices were going to go up and why this was an incredible time to buy, because we expected home prices to go up significantly. We were seeing MOI at levels of like 2.5 or 2. Well, here's where we are right now. We are at 1.88 months of inventory in July here in Jacksonville. 1.88 months. That is experiencing a very low supply of homes. We do not have enough homes to support the demand that we currently have. Now, if the media is saying that home prices are going to go down because sales have slowed dramatically, right? Sure, right? MOI has risen from 0.96 months of inventory in April to 1.88 months in July. So we are starting to see MOI tick up, which is exactly what we have been expecting. Nothing is happening out of the ordinary here. We would expect MOI to continue to go up, and it will normalize, right? It will get to 6 to 7 months of inventory, but it ain't happening now. And it takes a little bit of time for that to happen. So here's another thing to put it in perspective. July of 2020, 2 years ago, we were at 2.35 months of inventory in July of 2020. We are at 1.88 now. So now, to be fair, this is going to go up, whereas in July of 2020, I didn't know if it could go down any longer, but I knew it wasn't going to go up. Now, I expect it to trend positive, and you all should too. But just keep in mind that 2 months of inventory, 3 months of inventory, 6 months of inventory, 7 months of inventory doesn't mean crash. Historically, that has meant normal home price appreciation. So we got a long way to go. I'm excited to keep you all updated on this, but I just want people to look beyond the headline. Like, here's a headline. This is from a Fortune article that was just sent to me. The article says, across the nation, home sales are plummeting and inventory levels are soaring. Fortune magazine, across the nation, home sales are plummeting and inventory levels are soaring. I just told you, we're at 1.88 months of inventory in Jacksonville, which is one of the hottest markets out there to invest in. So clearly that's not accurate. The same article says, here's another good one. It says, Moody's Analytics chief economist tells Fortune, we've gone from a housing boom into a full-blown housing correction. And we will... And so then I thought about that. And I'm like, you know, Pablo, I go on these rants every once in a while about how terminology in real estate is not held to the same standard as terminology in the stock market. Well, in the stock market, Pablo, a correction in the stock market means that the prices for the S&P have fallen between 10 to 20%. That's when we start using the word correction. Yet here, this article says we have gone from a housing boom to not just a housing correction, a full-blown housing correction. Here's the rest of the statement, though. This is from the chief economist. He says, we will soon see year-over-year home price growth fall from a record of 20.6% to 0%. So this full-blown housing correction, all he's saying is that home prices might be flat next year. Like, do you think that that's maybe different than how that article reads?
Yeah, no, that's, as a marketer and somebody who understands copyright and understands the human brain, I know that they are trying to draw attention with language that they're allowed to use, but isn't necessarily, you know, accurate to ethical and in some regard, right? Like using the term correction makes you think, oh my God, 20% correction, like a stock market. But, you know, like you said, they don't hold it to the same standard for real estate. And what I'm hearing from what you're saying is, even if at some point we are headed towards a stabilized market with historically normalized home price appreciation of 4%, which would be somewhere in that 7 months of inventory, what the housing market did when MOI was higher than this to now was a pretty attractive scenario, right? So like if I'm thinking about investing, I want to get in on the side where I'm still receiving this upside and baking in this like higher appreciation now so that then it can make up for the slowdown later and then catch back up, right? Like you kind of described the short-term appreciation, the short-term MOI numbers as like baking in upside as opposed to like buying and then having to catch that upside later.
Let me scale you back a little bit here. Here's what I think, right? If we go back a year or two ago, it was really hard for me to get off of the talk track of like, buy for the long run. Short-term pricing is the least most important thing. Like it took me a long time and I finally caved. And I was like, guys, listen, home prices are lower today than they're going to be in the future. And you know what? It's probably a lot lower today than they're going to be in the future. And at the same time, interest rates are so low right now that like literally guys, you should buy right now because you're going to start banking appreciation because appreciation is going to happen. I mean, that's really what we've said on the show for the last 2 years. You know, we've helped a lot of clients buy because of that. Pablo, you've got 3 homes now and you've been able to, and you've benefited from that. What I'm excited about now is that we're going to go back to the normal way to buy rental properties, which is why are we paying attention to short-term pricing? You buy for the long haul. When you buy for the long haul, you benefit from all 5 profit centers. And the reason you need to buy for the long haul is because when you invest for the long haul, you can count on home price appreciation, but you can't count on it next year or the year after. You count on it when you hold for 10 to 20 year cycles. So buy and hold for the long haul, expect about 4.5% appreciation year over year on average when you hold for such a long time. We're going to get back to basics here. And I'm really excited about that. So I think, and I know that short-term pricing is the least most important part of the decision. I hope everybody really takes that to heart right now, because if you do that, you're going to buy turnkey rental properties and you're going to make better decisions than what your alternatives would be. Because if you look at other places to put your money right now, they don't look so great, especially heading into a recession, right? Short-term pricing is the least most important thing when it comes to rental properties. Long-term, this asset class still kicks butt. It kicks butt compared to the other asset classes as long as you can find a team that makes this a great experience. You know any teams like that, Pablo?
Yeah, I know at least one really, really good team like that I've been getting a great experience with, man.